Welcome back to Investing Talk Podcast.
Today we're looking at the hydrogen infrastructure company, NXXT.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We should probably start with their recent operational shift. I mean, for context, they were really struggling in late 2024.
They were, yeah. They missed revenue targets in Q4.
Right. They hit $18.7 million against a consensus of, $19.1 million? And they were dealing with some pretty significant supply chain delays. The market was skeptical, to say the least.
And that skepticism just makes the Q1 2025 results. I mean, they're so much more compelling. The latest reports show Q1 revenue hitting $48.2 million.
48.2.
Yeah.
That's a massive 37% jump. Year over year.
It signals something more than just a seasonal uplift. It feels like a fundamental change in how they're executing.
It is. And what's crucial to understand is where that growth came from. It's really about infrastructure deployment. The Hydrogen Infrastructure Solutions segment, or HIS, that was the real powerhouse.
Posting, 62% year-over-year growth?
An exceptional 62%, yeah.
And that ties directly back to physical delivery, right? We're talking about 18 new station deployments they completed in Q1 alone.
Mostly in California and Texas, these major logistics corridors. They're locking in these big multi-year contracts with fleet operators like XPO Logistics. It's proof they can actually build this stuff.
Moving from idea to actual commercial infrastructure.
Exactly. And then you have the manufacturing side supporting all of that, their modular electrolyzer units, or MEUs.
That segment saw a 49% year-over-year revenue increase.
Right. And this is where the story shifts from, tech developer to infrastructure executor. You just don't get those deployment numbers unless your manufacturing is running efficiently.
And efficiency seems to be the key word. The utilization rate at their Sacramento line hit 95% in Q1.
95%. And just think, a quarter earlier, they were, struggling at 72%.
That's a huge jump. That kind of operational discipline that has to translate directly into profitability down the line.
And we are already seeing it in the margins. I mean, the most significant improvement here is the gross margin expansion.
It's staggering. It expanded by 730 basis points.
Climbing from 31.1% to 38.4% year over year. For a heavy industrial company, that's a transformative improvement.
Okay, let's unpack that 730 basis point jump. That's huge, but is it sustainable? Or is this just some, one-time supply chain win?
That's the right question. And our analysis suggests it is sustainable. It comes from two structural advantages.
Okay.
First, vertical integration. They brought production of their bipolar plates and membrane electrode assemblies, the MEAs in-house.
The really high-value component.
The highest. And that move alone cut their outsourced component cost by a verified 22%.
So they're not just assembling parts anymore. They're controlling the core IP of the whole stack.
Precisely. And the second factor is just savvy supply chain management. They locked in long-term fixed price deals for their platinum group metal recycling feedstock.
At what price?
At $120 per kilogram. The spot market they were paying before was closer to $180.
Wow, so they locked in a $60 per kilo advantage.
For the long term. It protects their margins from all that commodity volatility.
That vertical integration, it really suggests they have a robust technology moat, which is exactly what you want to see in a sector this capital intensive.
It's all about control. They are one of only 2 U.S.-based companies with a full integrated end-to-end hydrogen infrastructure stack.
So they control everything from the electrolyzer manufacturing to station assembly.
To the PGM recycling and, crucially, that proprietary MEA technology. This isn't just about cost control. It's a technical advantage.
So explain that. Why does owning the membrane technology matter so much beyond just, shaving 20% off costs?
Well, it's the difference between being a commodity player and a performance leader. Their MEA tech lets them run their electrolyzers hotter and at higher pressures more efficiently and without degrading as fast.
Which means better efficiency, better durability.
Exactly. For a fleet operator, that's everything. It directly lowers their cost per kilogram of hydrogen.
So competitors, like a Plug Power or a Lin, who might rely on third-party MEAs, they're facing not only higher costs, but
they can't optimize the whole system as quickly. And on top of that, NextNRG created significant switching costs.
with the Nexos platform.
Right. Their clients are locked into that platform for everything maintenance, EPA, GHG tracking. I think 92% of their station clients have contracts longer than 3 years.
That's incredibly sticky revenue, and that operational performance is clearly flowing through to their financial health.
It is. They just closed that $22 million privately placed equity round, which was led by Sumitomo Corporation.
A huge strategic vote of confidence. And that bumps their cash balance up to what, $78.4 million?
78.4. And their debt is low, just $28.7 million in convertible notes that don't mature until 2028.
So the balance sheet looks stable.
It is. But the real discussion now is all about free cash flow, FCF.
Right. Management is signaling a major inflection point. They were deep in the red last year, but now they're saying positive FCF by Q4 of 2025. That feels aggressive.
It's very aggressive. They were negative $5.6 million just last quarter.
So what could go wrong? What could delay that timeline?
Well, getting from negative $5.6 million to positive in 3 quarters, it relies on 2 big assumptions. First, that Sacramento plant has to stay above 90% utilization.
No slipping up.
And second, they have to scale up their new Phoenix facility efficiently. That's a $28 million project. Any delays or cost overruns there, and that FCF target slips.
So they're betting big on growth, investing that $28 million this year. That's a powerful signal for management about the demand they're seeing.
It is. Now, shifting gears a bit, we should look at how the market is perceiving all this.
Yeah.
Because the sentiment has improved dramatically.
The institutional activity is what's fascinating to me. Ownership has just shot up from 14% to 29% since December.
29%.
And these aren't small funds. We're talking new positions from Sumitomo, Caxton Associates, Point72. These are heavy hitters. What changed for them?
2 things, I think. First is validation. The Q1 results prove the turnaround was real. Big money doesn't usually move until they see proof.
And the second?
The macro picture. They're positioning for the big federal funding, specifically the Department of Energy's Hydrogen Hub Awards. They see NXXT as a prime pure play to capture that money when it drops.
And the insiders seem to agree. The CEO, Robert Kim, bought 215,000 shares in February.
And the CFO bought 50,000 in March. And maybe more importantly, there have been 0 insider sales this year. That alignment is powerful.
On the technical side, the chart is confirming this. We saw that golden cross back in late March.
Yeah, the 50-day moving average crossed above the 200-day. It's a classic bullish signal. The whole structure suggests consolidation, but with clear upside potential.
Okay, let's talk about the calendar, because the next 90 days are just packed with potential catalysts. What are the big ones to watch?
There are 3 critical events. First, you have the Q2 earnings update in mid-May. The consensus is looking for revenue between $55 and $58 million.
So a beat there would prove that Q1 wasn't a fluke.
Exactly. It validates the operational ramp. Second, in early June, is the Hydrogen Industry Summit.
This is where they get to show off that tech moat we talked about.
They're planning to demo a new 1 megawatt MEU prototype. They're aiming for that 9.8 kilowatt hours per kilogram efficiency number. If they hit that, it solidifies their lead over competitors like LG Chem.
Okay. And the third?
The third, and this is probably the biggest trigger of all, is the DOE Hydrogen Hub Final Awards. That's expected around July or August.
And they're shortlisted for the Nevada and Arizona hubs, right?
Reportedly, yes. And that's not small change. Securing that could unlock anywhere from $80 to $120 million in federal funding.
Wow. That's almost 1.5 times their current cash balance. The impact of that would be immense.
It would be a game changer.
But we always have to look at the bear case. Even with all these catalysts, what's the biggest risk right now?
The risks are really in 2 areas. First, liquidity. The average daily trading volume is still, relatively low.
So any bad news could really amplify a sell-off.
Exactly. High volatility. And second, despite all the improvements, they're still an unprofitable company. That makes them super sensitive to any delays in that DOE grant or any slippage in that FCF timeline.
And the management transition. A CFO retiring is always something that makes institutions pause, at least for a bit.
For sure. And what about regulatory risk, like the new hydrogen purity standards in California?
Well, that risk seems pretty contained, again, because of their tech moat. Since they control their MEIs in-house, they can adapt to new standards much faster than competitors who rely on outside suppliers.
So to synthesize all this, the data suggests NXXT is making that really difficult transition from a high-risk development story to a real execution story.
They're leveraging a defensible technology moat, seeing clear operational improvements, and attracting some serious institutional money ahead of these huge near-term catalysts.
Right. It's a story of reduced costs, expanding margins, and a clear, if aggressive, path to being free cash flow positive by year-end.
Here's a provocative thought for you then. Given that expected FCF inflection and the sheer size of that potential DOE grant, how much of that is already priced in? Or is the current valuation still assuming something goes wrong? Something for you to research further as those dates get closer.
We'll leave you with that. Don't forget to subscribe to catch our next analysis.